Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:16 a.m. Central Time, and I am recording this in preparation for the market day of January the 7th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing and trading decisions that you make. So let's dive right in. Yesterday was a significant down day. We've had 5 down days in a row. We are at this point, after 5 straight losses straight into a Tuesday. This is really setting things up for something of a short-term rebound. And indeed, when that particular set of circumstances has come together, 5 straight losses into a Tuesday, 10 of 12 times, that has been a setup for a bounce. So something to think about. Certainly in the overnight action. Let's go ahead and dive into our morning report. In the overnight action, all 4 of the indices are up about 0.5%. Indeed, I know we took an overnight trade, and that worked out very well. So when you get to these extremes, it's always a little bit difficult to say, okay, I think we're at a bottom. But certainly to start looking for opportunities, perhaps if you're a put seller, your favorite core portfolio stocks, now might be the time to take a look at setting up some puts, but start thinking about maybe looking for some signs of a bottom. In terms of other futures markets last night, crude oil broke its recent weakness and was actually up in the overnight, not by much, but compared to the previous 2 nights, certainly it seems to have found some support, at least temporarily, up 0.27%. Euro down 0.67%, and then gold also down about 0.5%. In our overseas markets, Shanghai up 0.67%, Hang Seng up 0.83%, the DAX in Germany up over 1%, FTSE also 0.81%. So in general, all the markets that would be expected to be bouncing seem to be bouncing in the overnight action. In terms of key macroeconomic reports for today, don't forget we do have the FOMC minutes this afternoon, so not the typical time that you expect all of a sudden action to come in. Well, this could impact markets today. You could see after the opening session that things may settle into a sideways pattern going into this afternoon's minutes release, and then of course take off with some volatility after those minutes are released. In terms of other U.S. action coming up, of course, Thursday we have our regular unemployment report, and I don't see anything else that really gets my attention there. Oh, do remember, of course, today we also have crude oil inventories. That will be at 9:30 Central Time this morning. So anytime you're a crude oil trader, you've got to be aware of that one. In terms of market volatility, some of the things that we've obviously seen a lot of pop in volatility in recent days, as you see, especially on the S&P. Note that the last 4 trading sessions have had at least a 1 standard deviation move. 2 days ago we had a 2 standard deviation move, and indeed the S&P has been more volatile than the other 3 indices. So they've been popping, but perhaps the S&P has been the most volatile of the 4 indices. Now, that being said, its implied IV has not risen quite as dramatically as some of the others, and indeed you see the Russell is up at an 81, and indeed the NASDAQ and the Dow are also in the upper third now. So quite a bit of increase in volatility here, and we may start to see some of these things kind of fade perhaps if we do get a bounce action in the next day or so. Notice that the short-term VIX is now over 20.53. The regular VIX is right around that area as well. I believe it was just under 20 if I remember correctly. So certainly we are not in a complacent environment going into the new year. In terms of market timing, not a lot of changes here today. We had a long report yesterday, so I'll be a little bit shorter today. Most of this is very much in line with what we had yesterday. We think we are still in phase 3, bull flags, bull flats, higher highs, higher lows, while we have certainly started to threaten putting in a lower low. We have not done that as of yet, so our intermediate term trend is still intact, and that is one of a bull trend, but we certainly do have lots of warning signs in place. We do have market and correction. We do have on our active trader market posture a call for no new intermediate or short-term bullish trades. Portfolio sizing for new positions, if you should take some, should be greatly reduced. Market timing opinion still remains very bullish. We were very bullish going into yesterday. We remain even very bullish today. Obviously, starting to look for setups for a potential at least short-term bounce. The market forecast opinion, notice that the NASDAQ has now dropped into very bearish. It dropped below a 50. And some of the other indices are also threatening to drop below a 50 and probably will. Unless we get a really sharp bounce. So S&P at 59, the Dow at 61, and the Russell at 66. So this has really fallen off in the last 5 days and has become quite concerning. We are still at hedge warning level 1 plus, so market and correction. Lots of warning signs that you've got to be very careful with management of your current positions, and yet at the same time might be starting to look for whether we might get a bounce, at least a short-term setup. Option income strategies are not recommended at this time, as the VIX is above the threshold in which option income strategies are generally conducive. You're prone to not being paid enough for the amount of volatility that's currently reflected in the market, and you will get smashed on many of those strategies unless you are extremely nimble. In terms of our sectors, obviously quite a bit of deterioration across all the sectors. Probably the thing to note here is what has held up the best. Utilities and retail have held up the best. Utilities was, of course, the story of 2014 and continues to be holding up well. I know in my own positions, utilities and REITs and bonds, TLT is on a tear, and indeed may be coming into a long-term resistance area. So if you are in a bond position such as TLT, take a look at your charts. Take a look at the weekly charts, go way back, and you're going to see that the last significant swing high on TLT is not that much further above where our current price action is. So that should start to come into play. We've been on a bit of a parabolic move on TLT. So if you are in those kinds of positions, you might be looking as a tell there. Indeed, once TLT turns, it may be the early warning sign that the indices are going to turn, and obviously a close relationship between them. Same thing with the REITs. Obviously, they've also been benefiting, much like utilities and bonds in this kind of environment. So they have been very, very hot of late. In terms of just normal, what I call normal business sectors, the retail obviously has been holding up quite well, probably direct beneficiary of lower energy costs to the consumer, being to the benefit of some of the retailers. Now, not all retailers are benefiting, so take a look at your favorite retailers and see where that price is going. You know, some people will be doing better than others. Retail is not all is equal kind of environment. There are higher end retailers, and then there are, you know, the Walmarts of the world. In terms of our percent change by asset class, obviously everybody was hurt when we sit there and we say that, for example, utilities held up better. Well, better is a relative term. You still lost money on many of those utility positions yesterday. So something to keep in mind. And there's, you know, obviously, even if we go all the way back to now a month, only utilities on month over month is still green. So that's why it's so important to be in capital preservation mode and risk management mode when you're in a market and correction. You can lose a lot more than there is opportunity to be made often in these kinds of market environments. So first and foremost, capital preservation. So that, I think, is enough for today, especially after yesterday went well over our 10-minute mark. So greatly appreciate everything. As always, we most appreciate if you will like us on your favorite social media platform. We're in all your favorite places. And then, of course, in terms of where to find more information or send us an email, you can see those numbers there. Free trials are available to each of our 3 live trading rooms. Please check us out. And then, of course, disclaimers. Hit the pause button if you'd like to read this in more depth. And as always, we thank you for being with us in the Falcon community.